So what happens when a massive geopolitical oil story smacks right into the most important jobs report of the year? That's what we're breaking down today. We're going to take these two huge market-moving forces and synthesize them into a clear, actionable plan for the week ahead. Okay, so let's get right into it. The big conflict for the market this week, really the tug of war, is between a potential oil supply shock coming out of Venezuela and the Federal Reserve, which is basically waiting on pins and needles for the U.S. jobs report to decide its next move. And this slide lays it out perfectly. On one hand, you've got this geopolitical wildcard, a flood of oil from Venezuela that could totally hammer crude prices. But on the other hand, you've got this domestic signal, the jobs report. And here's the twist. Weak data could actually be good for stocks because it might just force the Fed to cut interest rates. These two narratives are heading straight for each other. All right, let's tackle that first big force, the Venezuelan oil situation. And I mean, the scale of this is it's absolutely massive. We are talking about waking up a sleeping giant here. First, you just gotta let this number sink in. Venezuela is sitting on 303 billion barrels of proven crude oil reserves. That's the largest on the entire planet. It's a fact that, honestly, the market just seems to forget about most of the time. But it's not just the amount of oil, it's the value. At today's prices, you're looking at a staggering 17.3 times trillion dollars worth of oil just sitting there. You see a number like that, and you start to understand why this story is suddenly a huge deal for energy traders. But here is the great paradox, the thing you have to understand. They have all this wealth under their feet, but because of all the instability and just completely broken infrastructure, they're producing less than 1% of the world's oil. And that right there is the whole story. The opportunity isn't in the oil itself, it's in fixing the broken system to get it out. So where's the investment angle in all this? Well, it's not about drilling new wells. It's all about repairs. You see, the big refineries on the U.S. Gulf Coast are actually built specifically to handle Venezuela's type of heavy crude. That means U.S. companies are in the perfect spot to snag billions in contracts to fix their pipelines, their pumps, all of it. It's a unique angle that's more about engineering and construction than just betting on the price of oil. So how do you actually play this? Well, let's look at some names. You've got Chevron, ticker CVX. They're a leader, already have a footprint there, and the stock popped over 2% on Friday. Then there's ConocoPhillips, COP, which is also perfectly set up for this kind of work. It jumped over 3%. But my favorite way to think about this is OIH, the Oil Services ETF. This is the picks and shovels play. You know, during a gold rush, you can bet on the miners finding gold, or you can bet on the guys selling them the picks and shovels. OIH is the second one. It's a bet on the repair work itself, which kind of insulates you if crude prices get volatile. Now, there is a big risk here, and you have to watch this level. Crude oil has a major floor right around $55 to $57 a barrel. If all this potential Venezuelan supply actually hits the market and breaks that support level, well, oil prices could fall and fall hard. That would obviously hurt the big producers, but it makes that picks and shovels play, OIH, look even smarter. Okay, let's pivot. We're shifting gears from the global oil story to the huge domestic issue that has the Federal Reserve's complete and total attention. Because right now, the only thing the market cares about more than oil is the jobs data that's going to dictate the Fed's next move. And here is the economic roadmap for the week. It all kicks off Monday with manufacturing data, but things really ramp up on Wednesday with services data and job openings. But the main event, the one everyone is waiting for, is Friday morning, non-farm payrolls and the unemployment rate. I can guarantee you Friday is going to be a volatile day. Now, you really have to get your head around this bad news is good news dynamic that we're in. See, the Fed actually wants to see the job market cool off a little bit. So if we get a soft, kind of weak jobs number on Friday, it tells the market two things. One, the economy is slowing down, which is what the Fed wants. And two, it gives them the green light they need to keep cutting interest rates. And lower rates are usually very bullish for stocks. Okay, so let's put these two giant forces together, the oil story and the Fed story, and see what it's doing to the broader market. We'll use the S&P 500 to see what's going on, because frankly, it is at a massive tipping point right now. When you look at the chart, something really important jumps out. The S&P 500 has put in what's called a double top, right at its all-time high. For traders, this is a classic warning sign. It basically means the market tried to push higher, failed, tried again, and failed again at the exact same spot. It suggests the upward momentum is running into a serious wall of resistance. So this is the number you need to burn into your brain this week, 680. We're talking about the S&P 500 ETF SPY. That level is the absolute line in the sand. It's both a technical and a psychological support level. If we get a clean break below 680, that's a huge red flag that the short-term trend has changed, and a real correction could be getting started. All right, so we've looked at the big picture. Now let's zoom back in and get to some specific, actionable ideas, stocks that are setting up really nicely because of this whole market environment. Okay, 4 stocks to watch. First, Tesla. It's been down 7 days in a row, so it is on high alert for a bounce. That $440 level is the key support to watch. Next is JD.com. We're seeing some huge institutional money flowing into calls, and it's bouncing nicely off a series of higher lows. Then there's NVIDIA. It had a nice bounce off a major trend line, but we really need to see it break and hold above $8.50 for confirmation. And on the flip side, keep an eye on Palantir. If it breaks below 1660, that's a critical support level, and it could signal a lot more weakness to come. But, maybe one of the most fascinating setups I'm seeing right now is this enormous bet that some big institution is placing on advanced auto parts, ticker AAP. We're talking about $1 million bet that this stock is about to make a major comeback. And here's how the trade is structured. Someone is risking $1 million for a potential payoff of $2.6 million. They're doing it by buying calls that don't expire until 2026. The thesis here is pretty clear. They're betting that this stock, which has just been crushed, is finally bottoming out and is due for a massive snapback rally over the next couple of years. So let's tie it all together. This really brings us to the core question for every single investor this week. Is all this drama with oil and jobs reports just short-term noise? Or is it a real, fundamental risk that could derail this market? But before you decide, you have to see this. Historically, when the S&P 500 gets stuck in a tight trading range for about 3 months, like it has been, the market is higher 2 to 4 months later, 94% of the time. 94%. That is a powerful historical tailwind that is very, very tough to bet against. So that's the final question. With history telling us there's a 94% chance the market goes higher, is this week's news just a bunch of noise we'll forget about in a month? Or is this one of those rare times where there's a real risk that could actually break that historical trend? That's the $1 million question you have to answer for yourself this week.